Hello, everyone. Welcome to today's webinar. My name is Fawad Razakzada, market analyst with Think Markets. So this webinar is divided into two parts. We will discuss some pre-NFP leading indicators to try and come up with a rough idea of how the headline jobs number may look like and how this will impact the markets. Now, the second part of the webinar will be all about live charts and technical analysis of a few major currency pairs, gold and indices, in order to provide some actionable trade ideas after the jobs report is published. So for those of you who have joined us, and I know there are quite a few of you guys, please don't hesitate to ask us questions during this webinar. And for those of you watching live, please consider joining us live. For those of you who are watching us on YouTube, please consider joining us live next time so that you can ask us questions on any particular market you are interested in. Okay, so before we begin, please read through the risk warning and the disclaimer. I will help you by reading the first paragraph. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Just a reminder then, this webinar is repeating every month. It happens at 11:30 on the first Friday of the month when the US jobs report is published. And as I mentioned earlier, it's basically a preview of the jobs report. We talk about some of the leading indicators that are released throughout the week and discuss how this will impact the likely outcome of the actual jobs data and how that in turn will cause markets to move. And then we will discuss some levels on the live charts before taking your questions, okay? So the non-farm payrolls report has traditionally been one of the most eagerly anticipated macro events for the markets. Obviously, this is because one of the Fed's mandates is to maximize employment, the other being to keep inflation around the 2% average target. Now, over the last couple of months, the focus has returned to jobs and inflation as the US and global economies recover from the pandemic. Now, how long will the Fed keep its emergency stimulus measures in place is the key question, and the jobs report has a big say in it. So right now, the Fed thinks that inflation is going to be transitory, and that it will want to see further big gains in employment before it starts to withdraw monetary support. And because of that, stock markets in the US have remained supported and very close to their previous record highs. The dollar has been coming under significant pressure each time it has staged a meaningful rally until this week. This week, we saw the dollar come back strongly, especially on Thursday, when we had a few data releases from the US, which were stronger than expected, suggesting that today's jobs report may actually beat expectations. So, judging by the dollar's outsized gains on Thursday, it now looks like the market is positioned for a stronger non-farm payrolls report than what the economists are expecting, with the so-called whisper number being around 790,000. But will the jobs report disappoint again? Last month, remember, expectations were for like a million gain in non-farm jobs, but it came in at 266,000. Which was massively below expectations. This time, the markets are, or I should say the economists are expecting 645,000 jobs in the non-farm payroll, in the non-farm sector to have been created in the month of May. This would see the unemployment rate fall to 5.9%. From 6.1% previously. and economists expect average hourly earnings to have risen by 0.2% month over month, compared to 0.7% in the previous month. Now, let me bring you in here, Victor. Based on what you've seen in terms of some of the non-farm payrolls indicators, do you think we will beat expectations this month, or are we going to see another disappointment?
Sorry, I was on mute. So considering the fact that the non-farm payrolls report last month came in pretty disappointing, I think that we might see this month's number actually catch up, meaning that we obviously see the unemployment rate ticking lower and lower. The expected unemployment rate right now is at 5.9%. I mean, for this month, for May, I should say. For the current payroll report is 5.9% from 6.1% last month. And at the time, we did have this downtick in the unemployment rate, which wasn't backed by the non-farm payrolls report. So I expect that they're going to kind of drift closer together, and basically the number that we could see this time around should be on the high side, at least from what we've seen so far, considering the high ADP number yesterday, which is basically gauging private payrolls. So yeah, the number was 978,000, which is like 50% higher than the current consensus for this month. And yeah, I think that there was this worrying number in the manufacturing PMI, ISM's manufacturing PMI and services PMI. Actually, the employment subcomponent of the ISM manufacturing PMI fell by 4.2%, 4.2 points to 50.9, which is barely in expansion territory. However, manufacturing jobs are generally a very small portion of the non-farm payroll report, and the services sector ISM number declined too by 3.5 points to 55.3. So the respondents in the survey curiously said that competition for labor continues to intensify due to lack of available talent pool. So that's something to have in mind. And the other interesting comment that they had was that they're working to fill vacant positions and they have difficulty in finding qualified candidates. So are we at the point where the non-farm payroll report, jobs are going to stop rising just because there is no people that are qualified to do the jobs? I wouldn't be surprised, to be honest, considering the fact how much the labor force has been eroding during this times of pandemics. The pandemic.
Indeed, so, it does. We've seen the participation in the labor market fall during the pandemic. People have become discouraged.
On this point, the current participation rate is 61.7%.
61.7%.
And compared to February 2020, the number is still lower substantially when it was 63.3%.
So just to clarify in case some of the participants in this webinar are not aware of the participation rate. This is, I think, this is the percent of the population who are available to work or are in the working age and should be in employment, but only 61.7% of those people are actually in employment, meaning that close to like 39% or 38% are still out of the labor force. Is that a correct way of putting it, Victor?
Yeah.
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 So it's not the percent of 61.7% is not the total population of the US. It's of the working population, those who can work. So the actual unemployment rate would be much higher if it was if we were to take into account everyone else. Now,
yeah, I think that we might see at some point a plateau in this service jobs. Basically, the need for different talent has intensified during this pandemic. As we all know, the digitalization of the economy has accelerated many times over, and obviously the lack of people that are qualified to do these jobs in the US is apparent.
Indeed.
So yeah,
so
that's going to be a challenge that I'm not sure that the Federal Reserve can address.
Indeed, I mean their hands are tied. They can only do so much to address the economy, and through monetary policy alone, you can't achieve everything. There has to be some government intervention from the US government, obviously. Now, bringing it back to the market. Sorry, go on, Victor. I don't mean to cut you.
Last but not least, the consumer confidence gauge was mixed when it was discussing the labor market, and consumers basically assessed the current labor market conditions as improved, with the number saying jobs are plentiful, rising significantly, while those that claim that jobs are hard to get declined. So
okay, so that's a very interesting
that
point.
generally bodes well. That bodes well for the jobs report.
And let's not forget also on this point, we have seen job cuts drop sharply for the last couple of months. This is reported on, I think, on a Thursday before the jobs report is out. Challenger job cuts. Yesterday, we saw another big drop in the number of job cuts in the previous month. So another positive indication of the employment. But going back to the last slide, actually, I mean,
let's go to the markets. Or
sure, we will just to highlight one further point. Now everything is obviously looking positive in terms of what we discussed, or most of the stuff anyway. The only my only concern is there are two things. Firstly, the ISM non-manufacturing, which is the services sector. Now, the US is a services-led economy. The services sector is the most dominant sector in the US economy. And the fact that employment fell or rose by 3 points less than the previous month is something that we can't ignore, albeit above 50 means that the sector employment rose, but it rose by less than the previous month. So take that into consideration, because it may point to a possible disappointment again in the headline job report. Also, the whisper numbers, we're hearing something like 900,000. I've even heard 1 million for this month. And the markets have already responded by buying the dollar and buying risk assets. Will we see disappointment if
actually
are not met?
This is an interesting point, as did we price in the positive jobs report yesterday?
So if we
when we got that
price that
unexpected strong ADP number.
Yeah. If say like we get a number close to 900,000, Victor, which would be above economist expectations, but more in line with what the whisper numbers are, the so-called whisper numbers are suggesting.
Yeah.
Do you think that will be enough to support the dollar?
I don't really think so, just because the Fed's stance is unlikely to change regardless of what the number is. The only worry I have in terms of not going long on the dollar at this point in time is actually the lack of conviction on part of at least a couple of Fed members to call for an end to their extremely accommodative monetary policy. So we have this question here from H. Hassan.
I think you just answered it. Yeah.
Yeah, who's saying, would you really expect the dollar to reverse from here, considering the money printing policy the U.S. adopts? Well, not at this point. Yeah, you have like the dollar should reverse the moment when we start hearing these comments on part of Federal Reserve officials who are going to start saying, perhaps it's time to start tapering asset purchases and adopt different policies. So yesterday was actually a very, volatile day for the currency markets, something that we haven't been used to in quite a while. So it was also helped by a new. Yeah. Hello.
Hello. Yeah. Hello? Now I can hear you. I don't know if the rest of the participants heard you, or it may be my internet connection.
Oh yeah. I just heard your MetaTrader reconnecting.
It's my I think it's my internet. Sorry, guys. Yeah, carry on.
So the we should see the dollar, to sum up what I was saying, that we should see the dollar in a sustained rally. The moment we start hearing comments on part of central bankers, Federal Reserve officials that are saying, okay, like, we're happy with our progress, we should start tapering our asset purchases or something like that. But you need to take into account yesterday also that another factor influenced the value of the dollar, and that was a relatively big news announcement made by the Russian Sovereign Wealth Fund that said that they're going to divest away from the dollar, which paradoxically actually led to a rally in the dollar because once they said that they're going to divest, that means that they're going to sell treasuries. And since they're selling treasuries, rates started moving lower, started moving higher, which actually supported the dollar.
Yeah.
So, yeah, that's something to have in mind as well. But yeah, I mean, overall, if you look at the weekly chart of the dollar index, I think that we could see a turn here. Like, it's not out of the question. We just need to close above this previous low, previous high in terms of dollar index. Yeah. So if we close above 90.50, I would say that we might actually see a continuation in this rally. Purely from a positioning standpoint, like, the market is probably overstretched being short the dollar, so we could see a correction here. I wouldn't rule it out.
Yeah. So I tend to agree with that view, but one thing that makes me wonder if we will see further losses for the dollar is this. The fact that we are very close to the previous lows,
To the previous low,
2020 low here, 2021 low here. This was the January 2020 low. There's going to be lots of stops resting below these lows. Okay, so the market has a tendency of setting up traders and then pulling the rug from underneath their feet. For example, a few weeks ago, we saw this bullish hammer candle on the weekly. Then we said if the market decides to break the high of that candle and stay above, that would be a bullish scenario. But if it starts to go back below it, that would be bearish. Lo and behold, it broke above, went back below, and then it took out liquidity that would have been resting below the low of that candle from trapped bull traders. This time we are seeing a very similar pattern here. You know, the market created these equal highs here for the last couple of weeks. The dollar index has risen above those highs. Right now it's trading above, but what we could see is, depending on the outcome of the data, obviously, and market reaction, if we go back below the previous week's high, which is this orange line, something like that, as soon as that happens on the lower time frames, I think we're going to see a sharp drop. So be mindful of that we could see something like this happen today and heading into the week ahead. So just because you're seeing a bullish candle here on the weekly time frame and a break of the trend line and so on, it doesn't mean that the bearish trend has ended. It means that the bearish trend has weakened, but it doesn't mean it has ended. So watch out for that possibility of price going back below the previous week's high. So on the daily, you know, the dollar index is actually testing resistance right here. If you look at this candle right here, this was the last high created before the market broke down. We're testing the bottom of that daily candle right at 90.60-ish today. So it's possible that the dollar could break down from here and head lower. So the key level to watch, therefore, is 90.44. Should we go below it, then that could be the trigger. And on the hourly time frame, this is how that looks. Let me just get rid of this. So any move below this area right here, retest of that could see a sharp drop to this congestion zone here initially. We may see a bounce from there. And then if the market wants to go further low, and if we take out this low, then at that point, it's going to be game over for the bulls. So that's the bearish scenario I'm looking at for the dollar today. Will it play out this way? Who knows? But it's best to be prepared nonetheless, right? Man. You always have to be tactically prepared. If X happens, I'm going to do Y. If Z happens, I'm going to do whatever. Yeah. So just
so basically, it's about holding this this line in the sand around 90.44. Let's have a look at different currency pairs, so that people that have you know, a little bit more specific. So the euro dollar basically we saw this breakout below 21.50. That was actually supporting the trend. What's that? The 21 day exponential moving average, or
you got it right.
So basically that level has been as you drew on the chart, the short-term invalidation level around 21.50 to 21.60. We broke through that. We broke below the previous low yesterday, and we're currently trading just above 121. So that's something that not many people expected into this payroll report, but it happened exactly as we feared, actually. I mean, we
Indeed.
mentioned on Tuesday, like that a surprise is possible both ways. Like it's not a done deal for the dollar. There's still we're still at this last stand. I'm calling it from looking at the
Yeah.
charts. If you can show us the weekly chart, how it looks right now, it's pretty. Actually, I would say it looks very bearish. But it's all about how do we close this week, you know?
Yeah.
So
It's not the first
if we
time. Sorry to cut you off. It's not the first time we've seen a bearish weekly candle, right? If I move this across,
yeah, sure.
we have seen so many bearish looking candles previously, including this one, for example, I've just highlighted.
Yeah,
It did lead to
and
some
we had this
weakness.
correction to
And then
117. So
yeah,
another leg lower is not out of the question here. And we actually, if you flip over to the 4-hour chart, we have this pretty decent head and shoulders pattern. We had it before. It was dropping, yeah. So you see the head and shoulders, the head a pop above 122.50, which failed miserably, and yeah, it got retested and it failed again. So yeah, this is there is this weight on the 4-hour chart. I would say that is positive for the dollar, for at least for the time being, from what I can see.
yeah. So I listen. I am. I've been expecting the euro dollar to go to 125. Okay, so this was from the previous webinar we drew. We said it may come back here and then eventually over time go up. That hasn't happened, and instead we broke down. Doesn't mean, as we discussed on the dollar index chart, that the longer term idea of price eventually going to 125 is invalidated. It hasn't. But in the short term, the structure has changed. We need to see renewed bullish price action to suggest that an eventual move back to 125 is still on the cards. And what I would like to see from a bullish point of view is, first of all, this level to hold. Okay, so this is on the daily. We're testing it's basically the inverse of what we saw on the dollar index. This was the most recent swing low. So I can move this invalidation level here now. Okay, we have to restart and remap things. Okay, this is the last low created prior to price making a new higher high. Yeah. So previously I was looking at the interim low right here, but this low was the last significant low created prior to price breaking out to a new high.
Yeah.
So for as long as that low holds, the path of least resistance would still technically remain to the upside, despite the head and shoulders pattern, despite the trend break on the 4-hour and everything. And specifically, what I would now look for a trigger would be for this red candle on the daily to turn green. Okay, so if support holds here and we move back above this red level, why this red level? Because this level was that prior invalidation level. And so if you go back above this level, it would suggest that the sellers are once again trapped after another bearish looking price action, failing to bring out the sellers en masse. So that's the key level of key pivotal level, I should say, that I am looking at right now. Yeah. So 121.32 specifically. Go above that, bullish, bearish while we hold below in the short term, at least. And in any case, if we go below 120.54, then it's game over for the bulls in the medium term.
Yeah, so let me challenge you a little bit on your bearish dollar view. How do you explain the really significant drop in the price of gold in recent days?
Yeah. Gold, well, there are so many factors in play for gold. Obviously, the dollar has rebounded, as we discussed, which directly impacts gold, right? There's also the fact that gold has had a major recovery, and what we're seeing is possibly a correction of the bullish trend. Technically, the trend line is still intact. Price is continuing to make higher highs and higher lows. So far, yes, gold has dropped sharply. We have to give the bulls the benefit of the doubt until the charts tell us otherwise. Now, when will that happen? Like the case of euro dollar, I have got my invalidation level right here, which is at 1808. This was the last swing low prior to gold breaking out to a new high in this year. Okay, so I reckon this is just a pullback in what still I consider to be a rising market. So yes, yesterday's sell-off looks vicious. It was, but today, we've gone back above the low of yesterday's low in a potentially positive development. Now, what happens next is obviously dependent on the outcome of the
on the data.
If we get a weaker than expected number, then we could see gold rise to test this potential resistance at 1894, which is the base of the breakout from yesterday. And what happens after depends on what gold does there. But right now it's testing the 21-day exponential, and it's close enough to this bullish trend line. So we could see the depths being supported today in any case. Indices continue to look really strong. This one, the DAX, we continue to talk about it. With the thing with indices is the markets know that the Fed and other central banks will not withdraw monetary support anytime soon. Even if the Fed does start to talk a bit hawkish, other central banks are still quite dovish, including the European Central Bank. Investors are therefore continuing to buy the dips in the stock markets, and the DAX has broken out to the new record highs. This was the chop zone that we were talking about.
It's
now taking it out.
It's continuing to look constructive, whilst the Nasdaq, for example, seems wobbly.
Yeah.
It created this huge bearish candle yesterday. Well, not that huge, but significant, substantial, probably 1.5% move lower. That also like plays into the same kind of ball game of the risk off tone that we saw yesterday and the rally in the dollar. So my only concern, like my main concern, not only, but my main concern is that the positive employment data has been priced into the market yesterday. And the moment we hear from a Fed speaker that they don't really care that the unemployment rate has ticked down and the non-farm payrolls report is so strong, like they're going to keep their monetary policy stance unchanged. That's going to just trigger another wave of buying stocks and selling dollars.
Yeah.
So
watch
out for that. Do we have any Fed speakers later today?
We have a number of speakers, I think, today. If you look at the economic calendar, we had lots of central bank members are speaking at the Green Swan 2021 Global Virtual Conference, and I think the Fed chair is speaking as well.
There you go. We have the opportunity to listen to central banks speak after the non-farm payrolls report.
Yeah.
So an initial positive number when everybody thinks like, oh, okay, like this is a great number, the dollar is going to go higher, and then you're getting this Fed speaker who says, well, we don't care about the data. We remain dovish. So yeah, that's something to be wary about.
Exactly. So that's that. Going back to the charts. I think we're gonna wrap it up now because we have run out of time. If you have any questions, please ask us now.
Yeah, sure. Let's hear if our audience has any questions. In the meantime, maybe perhaps we can just give a quick look at the British pound.
Yeah, the pound is still in the chop zone, isn't it?
Yeah, so basically it tested this key level around just below 141 this morning, and it rebounded. It made a tiny new low and it rebounded higher. So I would say that the current range persists. The only thing that can dramatically alter this situation is obviously the data that we're waiting for. But for the time being, it's still constructive, and the bulls remain in control as long as they hold the prices above this 140.80 area that has been tested earlier this morning, and obviously the previous high at 142.43 is the top side resistance, which is crucial for the bulls to overcome. For the time being, we are consolidating in the 141 area. We have been consolidating here for the past 3 weeks, I would say. Yeah. So we will be like any move outside of this area is likely to trigger some stops on either direction.
Yeah. So specifically, a level you could look at today would be the high from yesterday's candle, big bearish engulfing candle. So, you know, when you're studying technical analysis, they tell you that bearish engulfing candles are among key reversal signs. You know, we've seen 2 key bearish engulfing candles in the last couple of, well, this week alone. But you have to take into account the underlying trend, the sentiment, et cetera, before you trade on the back of these things. Okay, so in the past as well, we saw big red candles on several occasions, yet the cable continued to push higher. So what I'm trying to say is you'd be far better off trading in the direction of the underlying trend and looking for signs that the people that are going against the trend are getting trapped. So in this case, for example, would be a move above yesterday's high. That would be a clear indication that people who sold yesterday, they are now trapped, and their stops will be resting above these recent highs, and that's where price will most likely go to next. So if we go above yesterday's high, then that would be an idea for you to look for long cable, trades on the cable. Certainly, I would be doing that. So the level to watch is at 140.20. I because the trend is bullish for the cable, I don't think I'll even entertain the bearish trades, even if the jobs report is quite strong. I'd be more happy to sit back and watch price come back down to stronger support areas, including this zone here at around 140, if it does come down here, and then look for renewed bullish signals to go long again. The only pair that I would have, go on then.
No, the only pair that,
sorry. The only pair I'd say that I would consider looking long dollar trades on
bullish on the dollar,
on the Japanese yen, because Japanese yen is currently the weakest currency out there. People are selling the Japanese yen because of lack of haven flows and because of expectations that the Bank of Japan will allow inflation to rise if it indeed does rise in Japan.
That's a very bold thing to say for Japan.
Yeah. So that's the thing. Yeah.
So we have some comments from our listeners, and H. Hassan is asking where can people see the recordings, and this is on the Think Markets YouTube channel. As Fawad is just showing you, this is where we have all of our webinars getting uploaded. In the meantime, Emmanuel, I'm sorry, but we can't comment and give investment advice at this webinar. So we cannot advise you on how you should monitor, your positions. And basically the regulatory framework in place does not allow us to give you advice. So you're going to have to make your decisions based on the information that you have been provided. And in response to your question, will the dollar rise? We have no idea. We are just commenting on the incoming data flow and the prospective scenarios that can unfold.
Exactly.
So that's pretty much what we can help you with.
Yeah. So basically, we are setting, as Victor mentioned, we are setting up scenarios. If this happens, then we're gonna play the dollar short. If that happens, we're gonna play dollar long. So just going back to the dollar index chart, if this high breaks, that will be the trigger point for me to start looking for bullish dollar positions. Unless that happens, I'll be more inclined to look for bearish trades on the dollar. We let the market decide direction, dictate direction, and we, as traders and analysts, we are kind of surfing the waves, right? We're not going against the tide. We're going with the tide, with the flow.
We're not in the business of forecasting the market.
Exactly.
We're just So H. Hassan is asking what is the strongest currency at the moment? Well, at the moment, it's obviously the dollar. However, that's since yesterday or like the day before yesterday. If you look at it from a longer term perspective, it's definitely the British pound.
Yeah, I was going to say.
Like the best trade this year has been the British pound against the Japanese yen.
You read my mind there. I've just brought up the.
It's just a relentless rise that is. I don't even think that it's going to stop here.
Yeah, this brings me to a point I would like to make. I used to just to give you guys a little bit of advice here, if you can call it that. In the past, in my early trading career and analysis, I used to focus on wanting to be right, wanting to call the tops and the bottoms and so on. I learned that that's one of the most difficult things you can do. And the best thing as a trader, this is the key takeaway point I would like you to take from this webinar, okay? The best thing to do as a trader is, rather than looking for tops and bottoms, major tops and major bottoms, even if you were to catch a major top, does that mean you will be able to hold your position for so long to profit significantly from that one trade? It's very unlikely, because you will have moved your stop loss, etc., etc. You will have mismanaged it. Very likely to happen to you. The point I'm trying to make is, rather than looking for for major tops or major bottoms, look for trends. The best trades happen in the middle of strong trends. And one of the ways you could identify trends is it's very simple, really. If the market's making higher highs and higher lows, that's an uptrend. If it's making lower lows and lower highs, that's a downtrend. Usually, the best time frame to use is the daily, in my view. Just add a couple of moving averages to your chart to objectively tell you the trend direction. So in this case, I have the 200-day and the 21 exponential. The 200-day is telling me the long-term trend is bullish. The 21-day is telling me that the short-term trend is also bullish. What am I going to do? Am I going to short this? No, of course I'm not going to short this. I'm going to buy the dips. I'll continue to buy the dips until the chart tells me this strategy is not going to work anymore.
Otherwise, yeah.
Yeah. So even if at these levels you think, oh, it possibly can't go any higher. Well, I've seen crazier moves. What you need to do is focus on continuation patterns, right? So here, for example, triangle pattern, broke above, tested, and then went up. Another triangle, break above, massive rally. Another consolidation is currently taking place here. And if we break above that, it's likely we could continue towards 157, 158, who knows. But yeah, the point being is try to go with the trend direction, buy the dips in an uprise, in a rising market, and sell the rallies in a downward trend, which is why we continue to expect the dollar to weaken. And that's why I continue to bang on about looking for bullish trades in the pound dollar, in the euro dollar, in the Aussie dollar, etc., until the trend changes. With that said, we can't see any further questions, except there's one more from Mary. If NFP is 1 million, how many pips in EU likely to move and in what direction? Honestly, it's impossible to say. For me to say such a thing would imply that I know what every single trader trading the euro dollar is thinking. Not only that, I know what they will do, and I know exactly when they will take profit. It's impossible, right? Don't think like that. Think in terms of if the dollar, if the data does come out strong, 1 million, is the euro going to drop? I think so. Initially, it will drop. How far will it drop? Just let the market decide, right? Don't have any.
And also pay attention, aside from the headline, to the average or hourly earnings numbers. Because
absolutely.
If we see a dramatic uptick in average hourly earnings, like meaning that salaries are going higher, that would definitely be bullish for the dollar, because higher wages translate into inflation pressure.
Yeah.
So basically, yeah.
And another point on that, I'd like to say is, whatever the data is today, even if it's like 2 million, whatever, the most important point is how the market reacts. It's not the news, it's how the market reacts to the news. That's always going to be more important, right? So always listen to the market, even if you think the market is wrong, because ultimately price is what pays. So yeah, just bear that in mind. And the market always discounts news ahead of time anyway. So yesterday we saw a big move in the dollar. It could be because people expected today's data to come out really strong. So if today's data is going to be strong, are we going to see further strength in the dollar? That's going to be the key question, and I have my doubts.
Yeah, indeed.
Yeah.
So excellent. With that, let's wrap it up, and good luck with trading, regardless of whether it's the non-farm payroll number or whatever else you please. And speak to you next week.
Indeed. Before I let you guys go, just one final point. If you'd like to join us for, you see how we analyze the markets live on the chart. If you like that sort of stuff, make sure to join us live next week for our live market analysis webinars. So if you go to webinars on our homepage, we have a list of upcoming webinars here. We're going to add some more. You can simply click on register to obviously register your interest for that webinar. But yeah, make sure to join us live rather than watching it on YouTube, because you can ask us questions and we would be more than happy to answer any questions you have. Take care and have a good day, and be careful out there.